I need
Yes,
one
sir.
of you to speak to me. Can you
Yes,
hear
Yes,
me?
you're loud
we
and
can hear
clear,
you,
sir.
sir.
All right, then. Thank you. So last week we started project-specific cost of capital, and we said that project-specific cost of capital is computed when a company is diversifying or when systematic business and financial risk are expected to change as a result of undertaking a project. So once a company is moving from one industry to another industry, the existing work of the company will not be suitable to appraise projects in the new industry. Therefore, a cost of capital that will be suitable to appraise or to evaluate the projects will need to be computed. And that cost of capital is called project-specific cost of capital. And we said that, of course, whenever you want to calculate project-specific cost of capital, there are 5 procedures we are expected to carry out. Step 1 is to calculate or is to identify proxy beta. Step 2, you ungear the beta if it is geared. Step 3, you regear to incorporate the financial risk of the main company. Then step 4, you calculate cost of equity using capital Z pricing model. Then step 5, you calculate project-specific work. That's all. That's all you need to do whenever you want to calculate project-specific. But what is important is that you calculate, because on the day of your exam, examiner may not be specific. So you are just going to be told to calculate appropriate cost of capital. So you should be able to identify from the question, which cost of capital? Is it traditional work, project-specific work, or WAPOCA? So you should be able to deduce from the question given to you or from the scenario, the kind of cost of capital that you want to calculate. And that's why I was kind of specific telling you what you should look out for as far as project-specific cost of capital is concerned. So you only calculate project-specific work when a company is diversifying. That is, once you are told, for example, company XYZ, a manufacturer of hand towel, all right, a manufacturer of hand towel is diversifying into production of manufacturing equipment. So a company wants to be manufacturing equipment. So you are moving from towel, an industry, to textile industry to equipment, whatever the industry you want to. So once there's an indication in the question that a company is moving from one industry to another industry, and you're asked to calculate cost of capital, then that is when you compute project-specific work. All right. So we also talk about some terminologies you should get familiar with. We talk about business risk, financial risk, all right, proxy company. Then we talk about beta, that is asset beta as well as the equity beta. All right, so without wasting more time, let's solve question. Once we are done with that, then we'll move to weighted average cost of capital of the combined activity. Because based on our schedule, I've already told you ab initio that this cost of capital will take us for 1 month plus. And today is going to be the 6th class we are going to have on cost of capital. So it's becoming monotonous. So we need to move to another topic. All right. So today, if you cooperate with me, we are going to complete it. All right. So that when next we meet, we will be talking about a brand new topic. All right. So let's have a question under project specific. Okay. Now, when we get to weighted average cost of, sorry, when we get to capital budgeting, we are still going to have, we are still going to treat project specific cost of capital. But for now, so just you need to have an idea on how to estimate project specific work. So when we get to capital budgeting, we are going to solve another question that involves cost of capital and then including NPV. All right. So I need somebody to read illustration number 20, page 51 in your study material. One of you should help us. Who will take the lead? Yes, who is helping us? Oh, look at me. It's been a while. Okay, Samiat, go ahead.
Okay, good evening, sir. So illustration 20. Kilimanjaro PLC
Good evening.
produced domestic electric heaters. The company is considering diversifying into the production of freezer. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. We have fixed assets for Mississippi. Okay, then the
Leave the
power.
table. Move to the
Okay,
next
sir.
one.
Okay, sir. The power
Yeah.
value per ordinary share is 25 kobo for Mississippi and Zimbabwe, 50 kobo for
Take
Nel
it
and
again. I didn't hear you. Let me use my network.
okay, sir.
Samuel, take it from the power value. Take it from there.
Okay, sir. The power value per ordinary share is
Yes.
25 kobo for Mississippi and Zambezi, 50 kobo for Nel and 1 naira for
Zambezi.
Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at a rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its gearing to change significantly if the company diversify into the production of freezer. You are required to 1. Estimate what discount rate Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. 2. Corporate debt is often assumed to be risk-free. Explain whether there is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. Then 3. Discuss whether 4. System risks is the only risk that Kilimanjaro shareholders should be concerned with.
All right. Thank you, Samuel. Yes, that is the question. You will see that from the first requirements, you have to estimate what discount rate Kilimanjaro PLC should use in the appraisal of its proposed diversification into the production, into freezer production. Now, examiner wants you to calculate discount. Discount rate is the same thing as cost of capital. So you want to estimate cost of capital. All right. So you need to ask yourself, what kind of cost of capital is this one? Is it traditional work? Is it project-specific work or WACOCA? So because we are told that Kilimanjaro PLC is considering diversifying into production of freezer. So with that information, it means that we're expected to calculate project-specific work. All right? So to calculate project-specific work, there are 5 procedures you are expected to carry out. Step 1 is to identify the proxy bidder. In this question, there are 4 proxy companies. Okay? Kilimanjaro is the main company that wants to diversify into the production of freezer. So there are 4 companies already operating in the freezer industry. We have Mississippi, Limpopo, Zambezi, and then Nile. Those are the 4 companies currently operating in the freezer industry. So if that is the case, I will then go back to the question, where is the beta of each of these proxy company? You can see, examiner has given to you equity beta. All right, you are given equity beta for each of the proxy companies. So what this simply means is that I need to add up, because there are 4 different betas. I need only one beta. Then how do I get the 1 beta that I need? I will add up the 4 the 4 betas. I will divide it by 4 to get average beta. So that means I've identified the beta. Step 2 says you should ungear the beta if it is geared. Of course, this beta equity of 1.1, 1.25, 1.3, 1.05 will be geared if the 4 pizza companies has debt in its capital structure or in their capital structure. You can see that you are given bank loan. I told you when I was explaining to you last week that the beta will be geared if the proxy company has debt in its capital structure, debt in form of bonds, debenture, loan notes, or bank loan. So when you have that in the capital structure of the proxy company, it means that the beta given to you are geared. So if the beta is geared, you need to ungear it. How do you ungear it? I demonstrated the formula for you. So after we have calculated the ungear beta, then we now regear. Then you calculate cost of equity. Then finally, you calculate project specific work. So without wasting more time, we have identified from this question that this Kilimanjaro is diversifying into production of freezers. Okay, so if that is the case, we want to calculate project-specific cost of capital. Therefore, I will stop sharing this and move to the working notes. Okay, solution. Solution. So illustration 20. That's page 51. Page 51. All right. So we want to calculate project-specific work. The name of this company is Kilimanjaro PLC. Calculating projects specific cost of capital. Project specific work or project specific cost of capital. So that's what the examiner wants you to calculate. Even the examiner did not mention project specific. It's implied in the question that you know the kind of cost of capital because you can see that Kilimanjaro is diversifying into production of freezers. So we then say step 1 that you are going to carry out. Step 1 you are going to carry out is to identify the proxy beta. So there's no need for you on the day of your exam, there's no need for you to say identify the proxy beta. Worst case, just say proxy beta. So in this question, we have 4 different freezer companies. We have 4 different companies producing freezer. Therefore, I would then say beta of Mississippi plus beta of Limpopo plus beta of Zambezi plus beta of 9. So you add the 4 of them together, you find the average divided by 4. There are 4 freezer companies. Therefore, what's the beta of Mississippi? According to the question,
1.10.
beta of Mississippi is 1.1. So here will be 1. Let me move to. Okay, so beta equal to 1.10 plus beta or equity beta of Limpopo
1.25.
1.25 plus equity beta of Zambezi.
1.30.
So Zambezi is 1.3. Then 9 is 1.05. Okay. divided by 4 equal. So I had everything together, divided by 4. What do you have?
1.175.
1.175.
What do you have?
1.175.
1
1.175.
point. So let's say, let's restrict, because the beta given to us are in 2 decimal place.
Okay.
The betas given to us are in 2 decimal place. So let's restrict it to 1.18.
1.2.
1.18.
So the
Okay.
average beta is 1.18. So with this, we have identified the proxy beta. Then step 2 says it should ungear the beta if it is geared. We only do step 2 if the proxy company has debt in its capital structure. Also, we have identified that all the 4 freezer companies have bank loan in their in the capital structure. So in that case, it means this 1.18 is geared. If it is geared, then we need to ungear it. Step 2, ungear. You ungear in order to remove the financial risk of the proxy company. All right. So before I put down my formula, I told you that I gave you 2 different formulas that you can use to ungear. Whenever you want to ungear, it simply means you should calculate asset beta. And I said that the formula you are going to use to ungear will depend on whether risk-free, whether debt beta is given or debt beta is assumed to be risk-free. As far as this question is concerned, we are not given debt beta. So if that is the case, it is assumed that debt beta is risk-free. We are not given debt beta. So if that's, I would then say, okay, let me put it down. Since debt beta is not given, it is assumed to be risk-free. Therefore, the formula below will be used to ungear. Okay, so since the beta is assumed to be risk-free, therefore, beta assets will then be equal to beta equity of a gear multiplied by equity value divided by equity plus debt, 1 minus tax. So that's the formula we are going to use. So with this, beta asset, which is ungeared beta, is equal to the beta we have identified in step 1, which is 1.18, is geared because all the 4 freezer companies has bank loan. They all have bank loans. Therefore, this 1.18 is geared. So here is 1.18. Now we need to go and determine equity value of all the 4 freezer companies and then the debt value of the 4 freezer companies. So let's go and do the working. So this will be second one will be for regear. When you regear, you calculate CAPM, then WACC. Let's move here. So let's do our working here. So we want to calculate market value, working 1. So we need to calculate equity value. Equity value, depending on the information, the formula you are going to use to calculate your market value of equity will depend on the information you have in the question. So you are given ordinary share capital of 4 million, 9 million, 3.5 million, and then 5.3 million for Mississippi, Limpopo, Zambezi, and Nile. So you are not given number of shares. So since you are not given number of shares, Then, of course, you are going to convert the share capital to a number of shares. Then you multiply with XD share price. So we have done this previously under the traditional WAG. So here will be share capital divided by nominal value or nominal price multiplied by share price. Okay. So all those XD does not arise there because you don't have anything to do. You have nothing to do with dividend here. So we are less concerned with that. So just move on. Whether it is XD, UMDIV, all those one does not matter here. So you don't have anything like a dividend there. So now for Mississippi, we want to calculate number of shares. I will then go to the question, what's the share capital of Mississippi? Share capital of
4,000.
Mississippi is 4,000. All right. Figures are in thousands. So here is 4,000 divided by the nominal price. You recall when I was explaining to you, nominal price is the same thing as face value or par value. All right. So it's the same thing, or book value. So the nominal price of the ordinary shares for Mississippi is 25 kobo, 0.25. So here will be 0.25 multiplied by share price. I will then go back to the question. Am I given share price? Am I given share price? When you look at the table given to you, there's no share price. But I can see information on earnings per share. I can also see information on price earning ratio. So let's do that. In that case, our formula will change. Let me shift this one a little bit. Share price. Let me show you before I put it down. You know that in financial statement analysis, ratio analysis, for example, when you want to calculate price earning ratio, you said price earning ratio is equal to share price divided by earnings per share, isn't it? Are we together?
Yes, sir. With you, sir.
Yes, sir.
So this is the formula for calculating price earning ratio. So now in this particular question, you need share price, but share price is not given to you. So examiner has given to you price earning ratio and then earnings per share. So what you simply need to do to get your share price is to cross multiply this formula. Therefore, share price would then be equal to price earning ratio multiplied by earnings per share. So I can come here to say share price is price earning ratio multiplied by earnings per share. That's what examiner has hidden in is one of the things examiner has hidden in the question. So when I now want to calculate for Mississippi, I don't know the share price. I will quickly work it out somewhere. I will come here. What's the price earning ratio of Mississippi? Please, let's move fast.
12.
What's
12.
the price earning ratio of Mississippi is 12. 12
Yes.
times. So here is 12 multiplied by earnings per share of Mississippi.
25.
Earnings per share 25. So the earnings per share is in kobo, 25 kobo.
Yes.
25 kobo is the same thing as 0.25. Therefore, 12 multiplied by 0.25. 12 multiplied by 0.25. That's 3. So this one will then be 3 naira. So to now get the market value, I will then say 4,000 divided by 0.25 equal multiplied by 3 equal 48,000. Here is 48,000 That's the market value of equity for Mississippi. I will do for Limpopo. L. The share capital of Limpopo, according to the question, is 9,000. The nominal value of Limpopo is 1 naira. So 9,000 naira share capital divided by nominal price of 1 naira. So earnings per share of Limpopo, according to the question, is price earning ratio is 10 times. Then earnings per share is 53.3 kobo. 53.3 kobo. So I would then say 10. Here is 10 multiplied by 0.533. Okay. So what do you have there? 0.533 multiplied by 10. That's 5.33. So
Yes.
here is 5 naira 33 kobo. All right. So 9,000 multiplied by 5.33.
47,970.
So 47,970. 47,970. So I will do for Zambezi. The share capital of Zambezi is 3,500. All right.
Okay.
Then the par value of ordinary share of Zambezi is 0.25. So here is 3,500 divided by 0.25 multiplied by share price, which we don't know. The price earning ratio of Zambezi is 9 multiplied by earnings per share of 38.1. 9 multiplied by 0.381. Okay. That will give us
3.43.
3.43, right?
Approximately, yes, sir.
Okay. I'm coming. Let me look at my calculator just to confirm. Yes, 9 multiplied by 0.381. So 3.43. So that's 2 decimal place. 3.43. So whatever you have in your
48,000
calculator or
20
whatever
naira.
you, pardon?
48,020 naira.
Say
48020.
is naira.
Okay. All right. So divided by 0.25. So 48,000 what?
020.
20
48
naira.
zero.
Use whatever you have in your calculator, full number, that's 29. So A will give you 48,000 and
No.
48 million and 6,000 naira. Then finally, you have Nile. What's share capital of Nile? Share capital of Nile is 5,300. The nominal value of the par value of Nile's ordinary share is 50 kobo. So 53 divided by 50 kobo. 5,300 divided by 50 kobo, 0.50 multiplied by the price earning ratio of Nile is 14. Earnings per share of 9 is 32.3. So here is 14 multiplied by 42.3. Is it 42 or 32? Let me confirm.
32, sir.
32.
Yes, 32.3. Thank you. So here will be 0.323. All right. So multiply that with 14. What do you have?
4.522.
4.522. Here is 4.522. So 4.522
Multiply by
multiplied by
10,600.
10,000.
600.
You say 10,000? Yes. So what do you have in total?
47,933.
47,933.
Yes, sir.
47,933. So add everything together. What do you have?
Scrub small.
Help us scroll.
What do you say you have?
Scroll up.
Scroll, sir. Scroll up, sir.
Oh, sorry.
191,909.
191.
909.
Okay. 191,909. So this represents the total market value of equity of the proxy company. Let me shift it down. 191,909. This is total market value of equity for the proxy company. Now, so that is on one side. We also need to calculate, remember, from our formula, we have E is the equity value, D is the debt value, T is the company tax rate. So we have calculated equity value.
They are talking to you right now.
Please mute. Mute. Joseph, Ayodeji, then Femi. Three of you, please mute. Ayodeji, I'm waiting for you. All right then. So equity value we have calculated 191,909 divided by 191,109 plus the debt value. We don't know it. So let's go and calculate it. I will then go to the question. How am I going to calculate the debt value? So you can see in this question, the examiner has given to you bank loan. So this is non-traded debt. Bank loan is a non-traded debt. So we cannot have market value for bank loan because it's not tradable. Therefore, just add up together all the bank loans. That will represent your debt value. So D equal to, let me just put it there. This is not, the debt is not the bank loan. Let me put it this way. Bank loan, that is D, is not a traded debt. This is not a traded debt. Therefore, there is no more market value. Therefore, there is no market value. So if that is the case, D will be equal to, you need to add up the bank loan of all the four freezer companies. So bank loan of Mississippi plus the bank loan of Zambezi, sorry, Limpopo. What's wrong with you? Limpopo, Zambezi, then plus 9. So debt value equal to, what's the bank loan of
57,500.
57,500.
21,800.
For Mississippi, the bank loan is 5.3, right?
Yes.
5,300.
No.
Limpopo is
12,600.
12,600 plus Zambezi.
18.
Zambezi is 18,200. 18,200, then
Plus
plus
4,000.
4,000. Add everything so add everything together.
100.
40,100. Thank you. The total debt value for all the four freezer companies is 40,100. So I can then go up there. Let's go and put it down. Plus 40,100 into what's the tax rate of the proxy company? Let's go back to the question. You are told that from the
35.
second paragraph after the table, you are told that corporate taxes are payable at the rate of 35%. So examiner did not tell you whether this tax rate of 35% belongs to the four freezer companies or Kilimanjaro. So in that case, you are going to assume both the proxy company and the Kilimanjaro have the same tax rate. All right. So if that is the case, 35%, 1 minus 35%. So you are supposed to account for 65%. So 0.65. All right. So that is that. Then asset beta equal to, you start from the denominator. You start from the denominator, 0.65 multiplied by 40,100 equal, then plus 191,909 equal, that gave us 217,974. Therefore, let me just put it down, 217,974, just in case. Then we have the numerator, 191,909. Sorry, 191,909 divided by 217,974 equal, then multiply by 1.18 equal, that's 1.04. The beta asset is 1.04. That's on gear beta. This is how to calculate on gear beta. All right. So now that you have the asset beta, I can then regear to incorporate the financial risk of the proxy of the main company, which is Kilimanjaro. Step 3, you regear. Now, in step 2, you have removed the financial risk of the four freezer company. So you can see the gear beta we calculated was 1.18 in step 1. So you have removed financial risk. What you have thereafter is the business risk that measures the risk associated with the freezer industry. All right. So that's the asset beta we just calculated. So step 3 now is to regear to incorporate the financial risk of Kilimanjaro. Kilimanjaro is the main company. So whenever you want to regear, the formula you are going to use will also depend on whether debt beta is given or debt beta is assumed to be risk-free. Since we are not given debt beta of Kilimanjaro, it means it is assumed to be risk-free. So if that is the case, I would then say the beta equity gear. Let me just put it down for you. beta, debt beta, debt beta. What's wrong with you? Okay. Of Kilimanjaro PLC is not given. Therefore, it is assumed to be risk-free. So the formula below will then be used. So if that is the case, the beta equity gear will then be calculated as beta assets, to be calculated as beta assets multiplied by 1 plus 1 minus tax, debt equity proportion of Kilimanjaro. You will recall last week I told you that step 1 and step 2, when you are calculating project specific work, you need the information of the proxy company. Information in form of equity value, debt value, okay, debt beta, tax rates of the proxy company are what you need for step 1 and step 2. From step 3 to step 5, you need the information of the main company. In this case, the main company is Kilimanjaro. So I need equity value, debt value, tax rates, and then debt beta of Kilimanjaro. So we have identified that debt beta is assumed to be risk-free since we are not given. Therefore, I need equity and debt value as well as a tax rate of Kilimanjaro. So let's go and work it out. We're still on the same working number 1. So for Kilimanjaro, equity value, let me just put it there. Kilimanjaro, equity value will then be equal to, what's the share capital of Kilimanjaro? According to the question, the share
4,000.
capital,
4,000.
4,000. Thank you. 4,000 is share capital of Kilimanjaro. Then the nominal price of Kilimanjaro ordinary shares is 1 naira. Okay, here is 1 naira. Multiplied by share price. We don't know the share price. Price earning ratio of Kilimanjaro is 8. Earnings per share is 106. Therefore, 8 multiplied by 1.06. 106 kobo is the same thing as 1 naira 6 kobo. So when you multiply 8 multiplied by 1.06, this is 8.48. 8 naira 48 kobo. So 8 naira 48 kobo multiplied by 4,000. That's 33,920. 33,920. Then the bank loan, the debts. The bank loan of Kilimanjaro, according to the question, is
14,400.
17,400. Here is 17,400. All right. So that's that. Now, because I'm going to need this information when we get to work. So let's add everything together. Add these two together. What do you have?
51,320.
51.
Yes, sir.
Okay, 51320. So this represents the total value. total value for Kilimanjaro. So I will then come here, 33,920 is the equity value of Kilimanjaro. So beta equity of a gear equal to, we have calculated beta asset in step 2 to be 1.04. Here is 1.04 multiplied by 1 plus tax rate is 35%. 1 minus 35% will give us 65. Multiplied by debt equity proportion of Kilimanjaro. For Kilimanjaro, debt is 17,400. Equity is 33,920. So use your calculator to get the final answer. What do you have there? You are going to start from the division. All right. So say 17,400 divided by 33,920 equal, multiply by the bracket 0.65 equal plus 1 equal, multiply by 1.04 equal, that's 1.39. So the beta equity of a gear is 1.39. Okay, so that's that. Okay. Step 4 says you should calculate cost of equity. Using capping. Calculate cost of equity using capping. So KE equal to, let me see, because of space. Okay, I still have enough. So KE equal to risk-free rate of return, cost of equity equal to risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. So cost of equity equal. Let's go back to the question. Let's go and identify risk-free rate of return. Now, note, risk-free rate of return is the rate of return associated with government securities. Government security can include government bond or treasury bill. All right? Government bond or treasury bill. Those are examples of government securities. So when you go to the second paragraph after the table, you are told that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the treasury bill rate, which is currently 9% per year. So corporate debt, cost of debt is 0.5% above treasury bill rate. You are given treasury bill rate to be 9%. That treasury bill rate is your risk-free rate of return. Okay, so cost of debt is 0.5% over 9%. So that means corporate debt is 9.5%. So risk-free rate of return is 9%. I will then come here. Here is 9 plus beta we have calculated in step 3, 1.39. Multiply by, then market return. According to the question, you are also told that the market return is estimated to be 16% per year. So here is 16 minus 9. Therefore, cost of equity will then be equal to 1.39, 1.39 multiplied by difference between 16 and 9 is 7. Multiplied by 7 equal, then plus 9 equal 18.73. Cost of equity is 18.73. Finally, we calculate WACC. Step 5. We calculate project-specific WACC. So WACC will be calculated as, I've told you already, it's assumed that a company is financed with only equity and debt. We don't have anything like preference share here under project specific. So here is equity value divided by equity plus debt multiplied by cost of equity. Who is making noise? Please mute. Please mute. Simon, I'm coming for you. Rose. So debt value over total value, equity plus debt, cost of debt, then 1 minus tax. All right. Therefore, WACC will then be equal to, we have calculated equity value to be 33,920 divided by total value of 51. Total value, we've added it together. All right. We added it together to be 51,320. All right. This is the total value there. Rose, I'm coming for you. So here is 51,320. Multiplied by cost of equity, we got 18.73. Here is 18.73%. On one side, plus the debt value is 17,400 divided by total value. Total value is 51,320 multiplied by after tax cost of debt. I will then go back to the question. The examiner has told you that corporate debt is assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold bill rates of 9%. So 5%, 0.05 plus 9% will give us 9.5. All right. So here is 9.5. Okay. Then multiply by 1 minus tax. 1 minus tax is 0.65. Because tax rate is 35%. 1 minus 35% will give us 0.65. So give me from the left. Now, before I go there, now, Rose, talk to me. Rose,
Yes, sir. Good evening, sir.
good evening.
Yeah, sir, my question is on that solution point 4, where you will have 16. I don't know if you can just help me screw up a little bit.
18.73.
Yeah, this bracket, how did you get this 16 minus 9? Because I was
Is there in
thinking
the
that
question now? The market return is given to you as 16%. Is there in the question?
I've seen it. Thank you.
The risk-free rate of return is also there. I said that the risk-free rate of return is the rate of return associated with government security. Government security is treasury bill. So 9% is given to you for as the rate of return on the treasury bill. All right? So that's how we
Okay.
got the sense. Yes.
All right. Thank you.
You're welcome, Rose. So somebody is sending a chat. Please explain that capping again. I have a question. So what's the capping? What do you want me to say about capping? Ogechi, talk to me. Speak up.
Good evening, sir.
Good evening.
The capping, honestly, I don't think I understand anything we did there. You were very fast at that point.
I was very fast.
To me,
Okay.
yeah.
So you don't get how we don't understand how we got the 9% and the 16%. Is it?
From the response you gave to Ruth, I already understood how it got the 16 minus 9.
Okay.
Yeah.
So if you
So,
got it, then you should be able to understand how we got our 18.73 because the risk-free rate of return is 9% is there in the question. The market return is there in the question at 16%. The 1.39, we are the one that calculated it in step 3. That's the beta equity gear, right?
Yeah.
So slot into the formula, we got 18.73.
Okay, sir.
So whenever you want to calculate this is the formula for calculating capital asset pricing model. Risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. Yeah. Okay. So is it
Yeah,
clear
thank
now,
you, sir.
Ogechi?
Yeah, it's better now. Thank you, sir.
All right then. Then Emeka is also asking, I have a question. Yes, Emeka, speak up.
Good evening, sir.
Good evening.
Yeah, I'm concerned about that solution 5, calculation of WACC.
Okay.
That cost of debt, how did you get 9.5?
Yes, it's in the question. In the second paragraph after the table, examiner told you that corporate debt may be assumed to be almost risk-free. All right, and is available to Kilimanjaro at 0.5% above the threshold bill rate. We have identified threshold bill rate to be the risk-free rate of return, which is 9%. So if cost of debt is 0.5% above 9%, so that is 9% plus 0.5%. That's how we get the 9.5%. Okay, so let me.
Sir, what of if sorry, sir, what of if it's below?
Who is speaking? That's not
It's
Emeka.
Femi, sorry. I know, but I just wanted to quickly chip in. What of if it's below?
If it is below, that would be 9 minus 0.5.
Okay, sir.
So let me push it. Notes. KD equal to 0.5, or let me do this way, equal to 9% plus 0.5%. So KD is 9.5%. So because examiner told you that corporate debts may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the threshold bill rate, which is currently 9%. So threshold bill rate is 9%, 0.5% above 9%, that will give us 9.5%. Like Femi asked, what if it is below? Then it is 9% minus 0.5%. Yes, Olukemi, talk to me.
Well done, sir. Please, sir,
Yeah,
quickly,
welcome.
while you were scrolling, I saw something in the first step.
You saw what?
In the first step, it's like maybe the mistake there, I don't know.
In the first step.
Yes, sir. This second on here, the second step, sorry.
Uh-huh.
The 191909, is it not the same D that we are having in the denominator? 191109 is what we have.
909. Oh, sorry. This is 90. This one is zero of mine. It's 909. All right. It's 909, not 109. The answer is still correct. Thank you for the observation, Kemi. Okay. Yes. What's our WACC? What's the value for our WACC? So let's do it step by step. From the left, this will be multiplied by 33, 18.73 multiplied by 33,920 equal, then divided by 51,320 equal, that's 12.38. Here is 12.38%. Plus from the right. From the right is 17,400 multiplied by 9.5 multiplied by 0.65 equal, then divide by 51,320 equal 2.09. Here is 2.09%. Okay, when you add the two together, this will give us 14.47%. So approximately the project specific WACC is 14%. The project-specific work is approximately 14%. So that's that. Yes, Ogechi, talk to me. Okay,
Yeah, I'm here, sir.
you raise hand, talk to me.
Apologies to that particular. That should be number. I'm sorry, number 2. Yeah, number 2. That ungeared, where we
Yeah.
have 1.04. Can you help us take the calculation again? I actually got 1.5. I don't know. I may be wrong. So I'll be sure of how we calculated it.
You started from the denominator, which is 0.65 multiplied by 4,100
Oh,
equal, then plus 191,909 equal 217,974. So 217,974. Then the numerator, which is 191,909. 909 divided by 217,974 equal, then multiply by 1.18 equal 1.03889 whatever. So that's what gave us 1.04. You can do the calculation again. It's correct. All right? Okay.
okay, sir. Okay, sir. I'll
Yeah.
do that again later. Thank you.
All right. So now that's that. This is how to calculate project-specific work. So we are done with that. Then we can move to B part of the question. Before I go to second part of the question, let me know if you have any question on what we have done so far. If not, we'll move to requirement number 2. All right. Okay. So let's go to requirement number 2. In the requirement number 2, examiner is asking you that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt beta of 0.3. Now, there are 2 things examiner wants you to do in this requirement number 2. Number 1 is to explain if truly corporate debt is risk-free. Then the second part of the requirement 2 is to calculate project-specific work where you are given a debt beta of 0.3. All right, so that's what examiner wants you to do. So if that is the case, now you need to explain if truly debt beta is risk-free. Now, how are you going to tackle this? Let's use 2 examples. Let me put it down. This is requirement number 2. Number 2A. Requirement 2A. Roman figure 2, then A. Explanation, corporate debt. Let's put it as corporate debt. So you are told that corporate debt is often assumed to be risk-free. All right, sorry. Yes, you are told that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption. You assume it is risk-free. When you say risk-free, it means that as an investor, once you invested in debt, like bonds, you cannot lose your money. That's the interpretation. You can't lose your money. You are going to get your investment. You are going to get your money back. The interest will also be paid. So it is risk-free. That's what I mean by risk-free. Because we said that government security is risk-free because government is not going anywhere. For example, if Nigeria is owing you money as an investor during the period of the last administration of Buhari. If Buhari refused to pay you, Tinubu is now here. Tinubu should pay you. If the Tinubu refuses to pay you, whoever is coming in 2027, we pay you your debt. So government is continuing. All right, government is not going anywhere. Your money is secured. But we said corporate debt. Debt can be in form of bonds, debenture, or loan notes, specifically bonds. All right. So is it true that when you invest in bond, it is risk-free? You can't lose your money. Is it true? That's what examiner is asking you. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption. So, of course, you need to explain. I would then say, the assumption that corporate debt is risk-free is not a realistic assumption. It's not a realistic assumption because number one, default risk. Default risk. Now, when you talk about default risk is the risk arising from the inability of a company to pay the interest and the principal as an owing due. You are owing somebody. You are supposed to pay interest, annual interest, but that interest you default. You are unable to pay. You don't have the capacity. You don't have the means to pay the interest. Even the principal sum is due for payment. You are yet to pay because you don't have the money to pay. So that means there is a default. So if there is a default risk, can you say corporate debt is risk-free? No, because if I'm owing you debt. You cannot kill me because I'm owing you. The worst case will be that you go to court. You want the court to get your money from me. Then when we get to the court, I will tell the judge, see you, these are the situation. There is limitation so far. I don't have the capacity to pay. But when I have it, I will pay. When do you want to pay? So we now begin to say, okay, maybe I will be paying it instrumentally. That's the worst case that could happen. All right. But already there is a default. So if at the end of the day, of course, I'm unable to pay the entire debt, what will happen to the balance? Of course, the investor or the lender, we have to forgive that. We have to give we have to we have to forgive that because I don't have the capacity to pay again. So whenever there is default risk, of course, corporate debt cannot be said to be risk-free. Let me put it down. This is the risk. This is the risk arising from the inability of a company to pay the annual fixed interest and the principal. Okay, that's what is called default. You default. And that's why you see some of you, if you borrow money from microfinance bank, you see the bank that will be chasing you, be sending you SMS to any contact on your phone that so and so has borrowed money and has run away. We are coming with police. We are coming with EFCC. What's my business with that? How could you say a student of equity professional borrow money from you and you're now calling my number? They've done it in the past. I blocked them. How can you be calling me because of a student, a student I don't even know, you know? Or you say, they just say, oh, if you're a landlord, they will say your tenant borrows money, and then you use your number as part of your number is, I mean, the person dropped your number when they were seeking the loans. What's my business with that? When you are borrowing money, did you inform me that my tenant borrowed money from you or is going to borrow money from you? Why are you now chasing me, harassing me? I blocked the number. It was my business with that, So that means the borrower has defaulted. When you borrow money and you don't pay, that means you have default. You can imagine how many the billions of naira that some of these microfinance banks have lost. I have a neighbor. I have a neighbor in 2021 or thereabouts. The wife of the man went and borrowed from different microfinance banks. She invested it in a particular business, and then the business collapsed. All right. So she now, unknowingly to the man has secured the loan. All right. The man secured the loan using the woman secured the man's secured the loan using the man's vehicle. It's a long story, at the end of the day, the first week, when it was time for the woman to pay, the woman could not pay. All right. So the microfinance bank, they came around, they gave her a notice when she should pay again and all of that. Before you know it, we didn't even know that there are other microfinance banks. So the man has to leave the apartment. The man has to leave because the embarrassment was, in fact, he resigned from his office because those people, the microfinance bank, they know his office. Meanwhile, the man is not the one that borrowed the money. It is the wife that borrowed the money for investment. But he used the man as a guarantor. He used the husband as a guarantor. So the man has to resign. And the car. So the another funny thing is that so he has secured the loan using the man's vehicle with another microfinance bank. So the woman now sold the car again to another person within the neighborhood. So when the guy that bought the car was just driving, they went to the office, then he parked it in front of his office. The microfinance just saw the car and they traced the guy. This is not your car. This car has been secured on a loan. So you can see that kind of it. Now, when those people left, when they left my neighbor, when they left the apartment, 2 weeks thereabouts, another microfinance bank came in to say they now place some notice. They place the notice on our gate that okay, see you, the person that is living in this house borrowed money from us and is here to she has defaulted. I said, what's my business with that? Did you tell me when the tenant was borrowing money from you? Remove this thing, my friend. We tell the papers and about four of those notices they just placed on the gate. We destroyed everything. What's my business with that? So that's a loss. Till today they could not find them because they have to travel outside Lagos. They run away with the money. The man, it was so shameful for the man. She left the environment, the neighborhood as a result of that. Till today, the man has not recovered. It's a very big one. So this is what we are saying. All right. So when there's a default risk, of course, we can't say corporate debt is risk-free. Those microfinance banks that I just mentioned now, they lost their money as a result of that. Until maybe when they meet them tomorrow, I don't know, but that's none of my business. So let's move on. Yes, as a result, let's continue. As a result, corporate debt cannot be said to be risk-free. So when there's a default risk, corporate debts cannot be said to be risk-free. Another example, okay, let me use two. Another example, legal entity. Let's put it this way. Legal entity. What do I mean by this? Now, as a business, the liability of the shareholders of a company is limited to the amount they have contributed, because the company on its own is a legal entity that can be sued. The company can sue and also be sued, all right? So when the company liquidates, the asset of the company will be realized, that is, will be disposed of, and then the proceeds therefrom will be used to settle the liability. So when this happens, any balance of the liabilities that is still outstanding, any outstanding liability, what will happen to it? Who will pay it? All right, of course, the creditors will have to forfeit it. Let's say, for example, you are owing somebody 1 million naira. As a company, the company is liquidated. So you now sold the assets of the business. You realize 800,000. You have a liability of 1 million. You sold the asset at 800,000. So what will happen to the balance of 200,000? You have to forgo that, because you can't realize it again. Because you can't go after the shareholders to say, no, you have to pay me the balance, so you have to use your personal asset to pay. It's not possible, because it's a legal entity. All right. So as a result of that, can you say corporate debt is risk-free? No. Corporate debt cannot be said to be risk-free. So let's put it down. When a company is liquidated, or let me put it this way, the liability of the owners, the liability of a company, or the liability of the owners, the liability of the owners of a company or business of a company is limited to the amount, is limited to the capital contributed in the business. So when a company liquidates, its assets will be disposed of or will be realized. Its asset will be realized and the liability settled. And the liabilities will be settled. What's wrong with you? Will be settled. Therefore, any outstanding liability or debts, any outstanding debts will be forfeited. will be forfeited. Okay, so that's that. You cannot realize it again because you have already sold all the assets. The proceeds, you use it to settle the liabilities. So any outstanding debts will be forgone. It's going to be forfeited. All right. So hence, corporate debts. Corporate debts cannot be assumed to be risk-free. Okay, corporate debt cannot be assumed to be risk-free. All right. It is only in theory. All right. It is only in theory. It is only in theory that you can say corporate debt is risk-free. It is only in theory and not in practice or reality, not in practice. All right. So that's what the examiner is asking you. Corporate debt is not risk-free at all. It's not risk-free. All right. So that answers, wow. Remember the timers. Okay. So that answers that. Then number B part of the requirement number 2. Examiner is asking you to recompute your cost of capital because you have been given the debt beta to be 0.3. So we need to recompute the work. So that will be number 2B. Number 2B, high B. Where debt beta is given as 0.3. Okay? Where debt beta is given as 0.3. So we've already identified the proxy beta. Just repeat the entire 5 steps. So you can ignore step 1 because you already know is proxy beta is 1.18. So you can ignore that. But again, you can just put it there. Step 1, proxy beta, which is equal to 1.18. Step 2, you ungear the beta. Now that you have been given debt beta to be 0.3, the formula will change. Therefore, asset beta equal to beta equity of a gear multiplied by equity value divided by equity plus debt, 1 minus tax, plus the debt beta multiplied by debt value, 1 minus tax, divided by equity plus debt, 1 minus tax. Okay, so that's the formula to ungear when, because we are given debt beta to be 0.3. Therefore, beta assets of the proxy company will then be equal to 1.18. Equity value we got 191,909 divided by 191,909 plus debt value. Debt value we got, what did you get again? 4,100. 4,100. The tax rate is 0.35. So we are supposed to account. So we are supposed to account for 0.65. Okay. Plus the debt beta is 0.3. All right. So debt value is 4,100 multiplied by 0.65 divided by 191,909 plus 4,100.65. Okay. Therefore, beta assets is 1.04. You know, we have calculated it before, the one on the left. That's what gave us 1.04. So plus on the right, from the right, it will then be equal to 4,100 multiplied by 0.65 equal, then divided by 217. 217, is it 974? Let me check. I think I wrote it down somewhere the other time, except if I clean it off. Oh, I've cleaned it. No, yeah, I've cleaned it. I think it's 217,974. 974 equal, then multiply by multiply by 0.3, multiply by 0.3 equal, that's 0.04. Here is 0.04. When you add the two together, this will give us 1.08. So beta assets is 1.08. Please let me confirm the number from your end in case it's not correct. All right. Then step 3 is to regear. So, like I said, when you want to regear, you repeat the same formula you have in step 2, where the beta is given. So here will then be beta assets equal to beta equity of a gear. Repeat the same formula, equity value over equity plus debt, 1 minus tax. All right, plus debt value, debt beta, debt value 1 minus tax, equity plus debt, 1 minus tax. All right. So here in step 3, you are using the information of Kilimanjaro. In step 2, you use the debt beta, equity value, debt value, tax rate of the proxy. But in step 3, you are supposed to use the information of the main company, which is Kilimanjaro. So we have already calculated debt beta to be 1.08. 1.08 equal to beta equity of a gear. That's what we are looking for. Multiplied by equity value of Kilimanjaro is 33,920 divided by 33,920 plus debt value of Kilimanjaro 17,400. Tax rate is 35% for the two of them, so you have to account for 65%. Again, examiner has told you that you should assume that the debt beta is for both Kilimanjaro and the proxy company, which is 0.3, multiplied by the debt value of Kilimanjaro, 17.4. Tax rate is 35%. We are accounting for 65. All right. So here is 33,920 plus 17.4 0.65. So 1.08 equal, we start from the denominator, 0.65 multiplied by 17.4, 17,400 equal, all right, then plus 33 920 plus 33920 equal 45230. 45230. Let me put it down. Let's not forget. 45230. Okay. Then 33920. You are the ones who are supposed to be giving me this number. 33920 divided by 45230 equal, that's 0.75. Here is 0.75 BEG plus from the right. Okay, so here will be 17,400 multiplied by 0.65 equal, then divided by 45,230. 45,230 equal, multiplied by 0.3. 0.3 equal, that's 0.075. Here is 0.075. Okay, so what do we do? We collect like times. Therefore, 0.75 BEG is equal to 1.08. All right. 1.08 minus 0.075. Therefore, BEG would then be equal to, what's the difference? 1.08 minus 0.075. That's 1.005. 1.005. Then divided by 0.75. Okay. Divided by 0.75 equal 1.34. 1.34. This 1.34 is the beta equity of a gear. I will then move to step 4. Step 4 says you should calculate cost of equity, capping. So KE equal to risk-free rates. Again, on the day of your exam, there is no need for you to be writing formula again. You've already written formula in the first requirement. So just put your number there and move on. Beta, market return minus risk-free rate of return. Cost of equity, risk-free rate of return is 9%. The beta we just calculated is 1.34. Market risk premium is 7. 16 minus 9 is 7. Okay? So cost of equity will then be equal to multiply by 7 equal, then plus 9 equal to 18.38. 18.38%. That's the cost of equity. Finally, we calculate WACC. Step 5, we calculate WACC. So project specific WACC, of course, you know the formula, equity over equity plus debt, cost of equity plus debt value equity plus debt after tax, cost of debt. All right. So here for Kilimanjaro, equity value is 33,920. Total value is 51,320. Cost of equity we just calculated is 18.38%. From the left, then from the right. Debt value is 17,400 divided by total value of 51,320 multiplied by KD is 9.5. Let's do it this way. Multiply by 9.5%, multiply by 0.65 after tax. Okay. .65. So that's that. So from the left, this will give us 33920 multiplied by 33920 equal, then divided by 51, 320 equal 12.15. 12.15% from the left. Then from the right, it will be 17,400 plus 9.5. Sorry, multiply by 9.5. That's an error. 17,400 multiply by 9.5 multiply by 0.65 equal, divided by 51, 320 equal 2.09. Here is 2.09%, which is the same thing as what we calculated previously. Let me see, is it not the same thing as 2.09 under WAC? Yes, 2.09. That one has not changed. What has changed is the our cost of equity we calculated. Okay. So 12.15 plus 2.09. That's 14.24%. WAC is equal to 14.24%. WAC is approximately 14%. So there's a margin of error between the first WAC we computed, which is 14.48. I think the first one was 14.48. Let me confirm that. WAC 14.47%. Then this one is 14.24%. So there's a marginal error of about 0.2 something. All right. So that's that. Yes, Rose, talk to me, please.
So,
Rose,
sir, from the calculation we did now, the other phase of it, from the calculator is showing 2.90, but you see hyphen 0.03. I was thinking is 0.00, then before this 2.09. If you
which one
punch
are you talking?
the last place
Which
we
one are
complete, where you have this debt, this 17,400 times 9.5% times 0.65 divided by 513
513?
20.
Yeah.
So I'm
Yeah.
not disputing the fact that we have 2.90, but in the calculator, if you check, you see minus hyphen on top minus 0.3. So I was thinking maybe there are 3 zeros before you have 2.09.
No, maybe it's your own calculator. It's not.
It's not.
It's not a large number. If it's a large number now, you can be talking of maybe you have zero zeros behind your calculator, but this one is not. It's straightforward. Maybe it's you have mistakenly pressed something else. You can do it again. All
Okay.
right, Rose, try it
Okay, sir.
again. Yeah. All right. So you can see only one question sinks. Now let's just talk about the last one. You have to discuss whether systematic risk is the only risk that Kilimanjaro shareholders should be concerned with. Of course, the shareholders of Kilimanjaro should be concerned with the total risks that affect the business, both the business and the financial risk. It's not just about systematic risk. You know, we have systematic, when we get to portfolio theory, you are going to learn about portfolio risk. So we have systematic risk, we also have unsystematic risk. So the systematic risk is the risk that affects all the companies in an economy. All right, everybody, like, for example, you have inflation, you have pandemic. During the COVID-19, everybody in the entire world felt the impact of COVID-19. That's pandemic, that's systematic risk. All right, unsystematic risk is the risk that is peculiar to a particular company or industry within an economy. So, for example, during the in February this year, early this year in February, in Lagos State government and the Access Bank, they usually have an annual marathon race. Now, during that period, there's always a restriction of movement towards the Lagos Island. All right, the term people will not be able to move around Toy Mainland, to drive around Toy Mainland, and some other parts of Lagos within the island, like going to VI. So any route of that marathon race are restricted for movement during that period. So we have our centers one of our centers in VI, one is in Isolo. So during that period, equity professional will not be able to operate at the VI center. But of course, every other tuition center is not affected because apparently we are the only tuition center in VI in Victoria Island. So during that period, we don't open. We usually do online class. So that is what is called unsystematic risk, because that risk is peculiar to equity professional. Other companies in the industry are not affected. Okay. So when you talk about in this particular requirement, examiner is asking you whether the shareholders of Kilimanjaro should be concerned with only systematic risk. So to answer this, your response should be that the shareholders of Kilimanjaro PLC should be concerned with the total risk associated with the business. All right, if you like, you can then say we can define systematic risk. If you like, you can just just go ahead straight to the point by saying that the shareholders of Kilimanjaro should be concerned with both systematic and then unsystematic risk associated or that affects the business operation. All right. So that's that. So if you like, you can just explain systematic risk is the risk that affects all the companies in the economy, while unsystematic risk is the risk peculiar to Kilimanjaro PLC. Therefore, the shareholders of Kilimanjaro should not be concerned with only systematic risk, but the total risk that affect the business. That's all. That's all. So that's end of the question. Let me know if you have any question to ask so that we can just do the explanation of project specific, sorry, Wakuka. All right, I should be able with the remaining minutes that we have. So let's talk about Wakuka. If you are ready, I'm ready. Let's talk about Wakuka straight. Okay. Weighted average cost of capital of the combined activities. I call it Wakuka. Emeka, always raise your hand. Yeah, talk to me. What's your question? Or it's still the same? Oh, it's not you, Emeka. Rose, we are ready. Oh, okay. No problem. Now, you see, Wakoka is similar to project specific, but when do you calculate Wakoka? So far, I told you when we started this topic that there are three different ways you can calculate cost of capital depending on the information given in the question. We have traditional weighted average cost of capital, project-specific cost of capital, and then weighted average cost of capital of the combined activities. So we have done traditional work. We have also done project-specific work. This is the third one. Now, when do you calculate Wakoka? This is, because of time, let me just put it down. This is computed. This Wakoka is, let me put it, Wakoka is estimated when a company is into several different activities at the same time. Okay, so this company is a manufacturing company. At the same time, the company is into real estate, is into education. So when you have a project to evaluate across different industry that you operate, so instead of using different cost of capital to appraise the project, you need only one cost of capital that will be suitable to appraise any of the projects within the business portfolio. All right. So that is what is known as Wakoka. Again, I repeat, Wakoka is estimated when a company is into different business activities at the same time. All right, that's only when you compute Wakoka. Basically, there are 7 procedures, or let me just put it this way, steps. Let's see, we can, with the remaining minutes we have, let's see if we can even solve a question. But first thing first, let's have the procedure. Steps involved in calculating Wakoka. So basically, there are 7 procedures that you can carry out whenever you want to compute Wakoka. The step 1, so the first step is to identify the beta. Identify the beta of each activity. Step 2, ungear the beta if geared. Step 3, calculate market value of equity and debt of each activity. Step 4, you calculate weighted average beta. Calculate weighted average asset beta, or what we call asset beta of the combined, or you can also call it combined asset beta, combined asset beta, or beta asset of the combined. Then step 5, you regear. Now, how do you calculate beta asset of the combined? So beta asset of the combined is computed as beta asset of the first activity multiplied by total market value of equity and debt of the first activity divided by total market value of the first and the second activity. Okay, plus beta assets of the second activity multiplied by total market value of equity and debt of the second activity divided by total market value of equity and debt of the first and then second activity. So this is the formula you are going to use to calculate beta asset of the combined. Then step 5, you regear. It's the same formula we use under project specific to regear. Then step 6, you calculate cost of equity using capping. Then step 7, you calculate WACOCA. WACOCA is just your WAC. All right. So these are the 7 procedures that you are going to use to calculate WACOCA. So the only two different additional steps that you have under WACOCA is step 3 and then step 4. All right. You already know how to calculate market value of equity, market value of debt. All right. We did it under traditional WAC. It's still the same thing. All right. So how to regear, you already know. Capital asset pricing model, you know that. WACOCA, you know it. So at this point, let's have illustration. We should be able to complete this within the next 15 minutes. All right. So those are the 7 procedures that you are going to carry out whenever you want to calculate project specific, WACOCA, whenever you want to compute WACOCA. So go to your material. Let's have illustration number, I think that should be illustration number 19 or thereabout. Yes, illustration number 19, Columbia PLC. Columbia PLC. Who is helping us to read it? Do you have it open from your, okay, let me stop sharing. All right. So one of you should read for us. Who is helping us?
Columbia PLC provides training and financial services. The training services account for 2/3 of the value of the company. The company has a total debt to total market value ratio of 30%. The average beta and debt to total market value for financial service sector are 0.9 and 25%. The average beta and debt to total market value for training service sector are 1.5 and 12%. Other information includes 1. The equity risk premium is 3.5% and the rate of return on short-dated government stock is 44.5%. 2. Columbia PLC can borrow at 2.5% above the risk-free rates. 3. Corporation tax is 40% on taxable profits. 4. Assume that debt is risk-free. You are then required to estimate the cost of equity capital and weighted average cost of capital for Columbia PLC.
Yes, thank you, Femi. Now, from this question, you are told that Columbia PLC provides training and financial services. That's 2 different activities. Columbia is into training and is also into financial services. You are now asked to calculate cost of equity as well as a WACC of Columbia. Now, we have identified from this question that this company is into 2 different activities, training and financial service. So we want to calculate WACOCA. Step 1 is to identify the beta of each activity. To do this, I will then go back to the question. From the second paragraph of the question, you are told that average beta and debt to total market value of financial service is 0.9. Beta of financial service is 0.9. Beta of training service is 1.5. All right. Debt to total market value is the same thing as debt equity ratio, that is proportion of debt to the total market value. For financial service, the debt equity ratio is 25%. If debt is 25%, it means equity is 75%. For training service, if debt is 12%, then equity is 88%. So all these are the information given to you. So without wasting time, let's go ahead and solve this quickly. Okay. Let me see if I have sufficient space. All right, I will manage this. So solution to illustration 19. Still on page 46, I think. Or is it 46 or 51? Illustration, sorry, page 50. Here is page 50. So I want to calculate Wakoka. The name of the company is Columbia PLC. So for the purpose of your own understanding, I will say, since Columbia, don't go and be writing this on the day of your exam. It's just for your own understanding. Since Columbian PLC, if you write it, examiner will not penalize you. You are just demonstrating that you understand the question. All right. Since Columbia PLC is into training and financial services, the appropriate cost of capital will be Wakoka. The appropriate cost of capital will be the weighted average cost of capital, will be the Wakoka. Please, on the day of your exam, don't go and be writing Wakoka. If you are going to write Wakoka, you would have written it out fully in the first instance, just like the way I did here, weighted average cost of capital, and I put it in brackets, Wakoka, so which means that going forward, I will just be referencing Wakoka. But at your first instance, don't go and be writing Wakoka. All right. So step 1, we want to identify the beta of each activity. Or I can say there's no need for you to say identify the beta of each activity. Just say beta of each, beta of financial, which one comes first? Is it financial or training? According to the question, training comes first. So beta of training.
Financial that come first though.
No, training from the first paragraph. Training is denoted as T and financial denoted as F, services. So for training, I will then go back to the question, what's the beta of training given to us? According to the question, we are told that the average beta and debt to total market value for training service sector are 1.5. Beta of training is 1.5. So here is 1.5. Financial service. Again, the average beta and debt to total market value for financial service sector is 0.9. So 0.9 is the beta of financial service. With this, I've identified the beta of each activity. Then step 2, you are required to ungear these betas if they are geared. So you will only ungear if they are geared. So examiner has given you debt equity proportion, the percentage of debt for training service. The percentage of debt of training service you are given as 12%. Percentage of debt to total market value for financial service is 25%. So which means that since we are given debt equity ratio, it means that this beta of 1.5 and then 0.9 are geared. So if they are geared, you need to ungear it. So how do you then ungear it? I told you that the formula you are going to use to ungear will depend on whether debt beta is given or debt beta is assumed to be risk-free. According to the question, you have to assume that debt beta is risk-free. Therefore, I would then say beta assets equal to beta equity of a gear multiplied by equity value divided by equity plus debt 1 minus tax. If I like, I can use this. If I like, I can say, or I will still get the same thing. I can say beta equity of a gear, all right, multiplied by 1 divided by 1 plus 1 minus tax, debt equity proportion of each activity. I will get the same answer, all right? But let's just move on because of time. We have limited time left. So beta assets is equal to, for we want to calculate beta asset for training service. Beta assets of the training, BAT, beta asset of training equal to 1.5. Is it 1.5? Yes, 1.5 multiplied by equity value of training. Let's go back to the question. What's the market value of training? Examiner has told you from the first paragraph that the training service accounts for 2/3 of the total market value of the company. So if training service is 2/3, all right, that means the financial service is 2/3, sorry, it's 1/3. Now, that's not what we are looking for. That's just the market value, which is, of course, that's what you are going to do in step 3. However, you are told in the third paragraph that the average beta and debt to total market value of training service sector is 12%. Debt to equity ratio is 12%. Therefore, here will be 12. If debt is 12, it means equity is 88%. So here will be 88 divided by 88 plus debt is 12. Done. What's the tax rate? The tax rate given to us is 40%. So 1 minus 40% will give us 60%. That's it. So for training, I would then say 0.6 multiplied by 12 equal, then plus 88 equal 88 divided by 95.2. 88 divided by 95.2 equal, that's not correct. 88 divided by 95.2 equal, then multiply by 1.5 equal That's 1.39. Here is 1.39. The beta asset of training service is 1.39. Then beta asset of the financial service will then be equal to 0.9 multiplied by the debt equity ratio of financial service is 25%. So which means that debt is 25%, equity is 75. So equity is 75 divided by 75 plus debt of 25. 1 minus tax will give us 0.60. So 0.6 multiplied by 25 equal, then plus 75 equal to 90. So 75 divided by 90 equal, multiplied by 0.9 equal,
0.75.
that's
75.
0.75. So that's the beta asset of training as well as the financial service. I'll then move to step 3. Step 3 says you should calculate market value of equity and debt. So market value of equity and debt. So examiner told us in the first paragraph that training service account for 2/3 of the total market value of the company. So market value of equity and debt for training and financial. Okay, for training and financial service. All right. So for training, we are told that training account for 2/3 of the total market value. It means that financial service will account for 1/3. All right. So if training account for 2/3, then financial service will account for 1/3. So step 4 says you should calculate asset beta of the combined. Step 4. Combined, calculate, combined asset beta or weighted average asset beta, whatever you want to, however you want to put it, combined asset beta, BAC. All right. So the combined asset beta will be calculated as asset beta of training multiplied by total market value of equity and debt of training divided by total market value of equity and debt of training and financial plus beta assets of financial service multiplied by total market value of equity and debt of financial service divided by total market value of equity and debt of training and financial. So beta asset of the combined equal the beta asset of training. We calculated beta asset of training to be 1.39. 1.39 multiplied by market value of equity and debt of training is 2/3 plus asset beta of financial service. We got 0.75 multiplied by 1/3. 1/3 is the market value of financial. What's wrong with you now? One third Okay. Then the beta asset of the combined is equal to 2/3, 2 divided by 3 equal, multiply by 1.39 equal, that's 0.93, 0.93 plus 0.75 divided by 3, that's 0.25, 0.25. Therefore, beta asset of the combined is equal to 0.25 plus 0.93 equal 1.18. So that represents the beta asset of the combined. Yes, somebody is sending me charts. How did we get the 88 and 75 in step 2? Yeah, it's there in the question. In the question, you are told that the average beta and the debt to total market value is 1.5 and then 25%. So if that's what we are now saying is that 25% and then 12%, they are the debt equity proportion. So that is gearing ratio. So if the gearing ratio is 25%, it means debt is 25%, equity is 75. So if debt is 12%, equity is 88%. So I believe that is clear. That's okay. Yes. Thank you, Folashade Ruth. 100 minus 12, we give you 88. So, yeah. All right. Step 5 says you should regear. Step 5, you regear to incorporate the financial risk of the company. So from step 1 to step 4, you are talking about each of the activities, all right? But from step 5 to step 7, you are talking about the company. Therefore, I would then say to regear, you need the information of the company, the equity value, the debt value of the company, yes, any other information that relates with the company. So to regear, since the beta is assumed to be risk-free, I would then say beta equity of a gear is equal to beta asset of the combined multiplied by 1 plus 1 minus tax. Debt equity proportion of the company, not of the activity again, is debt equity proportion of the company. So beta equity of a gear equal to 1.18. That's the beta assets of the combined, 1.18. Then multiply by 1 plus tax rate is it not 40% or 35%? Let me confirm again.
40%.
Yes, tax rate is 40%. All right. So that means we are supposed to account for 60%. So here will be 0.6 multiplied by the debt equity proportion of the company. Let's go back to the question. What's the gearing ratio of the company? You are told that the company has a total debt to total market value ratio of 30%. Debt equity ratio of the company is 30%. It means that debt is 30%, equity is 70%. So here will be 30 divided by 70. Therefore, beta equity of a gear is equal to 30 over 70, 30 divided by 70 equal, multiply by 0.6 equal, plus 1 equal, multiply by 1.18 equal 1.48. Here is 1.48. That's the beta equity of a gear. Step 6. Step 6 says you should calculate cost of equity. using capital asset pricing model. Cost of equity using capital asset pricing model. So cost of equity is equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So cost of equity, I will then go back to the question. What's the risk-free rate of return? So according to the question, you are told that the rate of return on short-dated government stock is 4.5. Government security, I told you that risk-free rate of return is the rate of return associated with government security. So you have been given short-dated government stock rate of return to be 4.5%. That's the risk-free rate. So risk-free rate of return is 4.5 plus beta of 1.48. That's the beta we got in step 5. Multiplied by RM is market return. Examiner did not give us market return. You are given market risk premium. Equity risk premium is the difference between market return and the risk-free rate of return. So equity risk premium is given as 3.5. So the difference between RM and RF is 3.5, which is your market return. Sorry, market risk premium. Therefore, the cost of equity would then be equal to 3.5 multiplied by 1.48? Yes, 1.48 equal, then plus 4.5 equal 9.68. So 9.68% is the cost of equity. Finally, step 7, you calculate Wakuka. KW. So Wakuka is equity value divided by equity plus debt, cost of equity plus debt value over equity plus debt multiplied by cost of debt 1 minus tax. All right. So Wakuka, examiner stood in the question that still from the same first paragraph, you are told that the company has a total debt to total market value ratio of 30%. So debt is 30%, equity is 70%. So equity value is 70, total value is 100. That is 70 plus 30 is 100. Multiplied by cost of equity. Cost of equity, we got 9.68 plus debt value is 30%. Total value is 100. Multiplied by KD. KD is the cost of debt. According to the question, the examiner has told us that Columbia PSC can borrow at 2.5% above the risk-free rate of return. So the risk-free rate of return is 4.5%. 2.5% above 4.5% will give us 7. So our cost of debt is 7%. So here will be 7%. Let me write that. Let's do it this way. Multiply by 7%, then multiply by after tax cost of debt. Tax rate is 40%. We are supposed to account for 60%. So I can then come here, before I complete that, I will come here, notes. KD, cost of debt, you are told that it is 2.5%. All right. So which is 2.5% above risk-free rates. Above risk-free rates. And you know, risk-free rate of return is 4.5%. Therefore, KD equal to 2.5% plus 4.5%, and we got 7%. So that's how we arrive at the 7. In case, if you're on your own, you remember how we got the number. So let's take it from the left. 0.7 multiplied by 9.68 equal, that's 6.78. 6.78%. Then from the right, 0.3 multiplied by 7 multiplied by 0.6 equal 1.26. Therefore, Wakuka is equal to 1.26 plus 6.78, 8.04, 8.04%. So WAC is approximately 8%. That's it. This is how to calculate WACOCA. I think somebody was sending a message. What if preference share is, there's nothing, I've told you already, there's nothing like preference share under WACOCA. Under project specific and WACOCA, nothing like preference share. It's assumed that the company is only financed with, equity and debt, no preference share. Yes, Emeka, what's your question, please? Emeka. Emeka, do you still have your question?
Yes, sir.
Yeah, go ahead.
Good. In that number 6 solution,
Step. Okay.
calculating yes, step number 6.
Yeah.
How did you get 3.5?
Is there in the question, the examiner told you that the market risk premium, the equity risk premium is 3.5%. So, you know, when I was giving you the note last week, I defined the variables for you. I said that RM equal to risk is equal to market return. RM is market return. Okay. RF equal to risk-free rate of return. Okay, risk-free rate of return. Then the difference between market return and the risk-free rate of return is called risk premium. This is market risk premium. Market risk premium. That's the difference between RM and then RF. So in the question, the examiner has given you equity risk premium. You are told that equity risk premium is 3.5, which means that difference between market return and the risk-free rate of return is given to you. So there's no market return. You are only given the difference between market return and the risk-free rate, which is 3.5. So that's how we got the number. It's already given in the question. But the only thing is that you must know that the difference between market return and the risk-free rate of return is called market risk premium. All right? No worry, as we proceed, we are going to see similar thing like that. Yes, Emeka, is that clear?
Yes, sir. Thank you very much.
You are welcome. So any other questions so that we can close the class? Any other question? So, yes, we are done with cost of capital. We are done with cost of capital. So try as much as possible, not even as much as possible. It's your responsibility. You have that responsibility to read your books. So I want to encourage you. I've given you, you can see, this is just one topic that we have been doing over a month ago. We started from day 1. This is lecture day 6 because of only one topic. So if I can take my time to explain the concepts for over a month, just for you to understand, then the onus is on you to ensure that you read your books. So all you need to do now going forward, as far as cost of capital is concerned, is to begin to practice questions. Just begin to practice question and answers. And that's why I've told you, I've shared with you, you need to get the golden book. It's going to help you a lot. There are several practical examples that you have there that you can try on your own. All right. So try as much as possible, get it and start using it. The beauty about the golden book is that you are going to use it for your financial management. You also use it for strategic financial management when you get to professional level. And it's highly simplified. So if you are interested, just send me a DM, then I will we'll discuss it how you are going to get your copy. If for those of you, if you are close to our lecture centers, you can just walk in there and get your copy. All right. If you are outside Lagos, DM me, send me a DM, then we arrange how it will be delivered to your location. Of course, only those that are because if you are in the north, usually the motor park to the north is kind of a stressful, you know. But only to Abuja. Abuja is easier to send something to Abuja, the eastern parts of Nigeria, southern parts, all those ones. But the only area where we usually have challenge is sending to those states around the north, like Gombe, Nasarawa, Niger, except if the person will go to Abuja and pick it, or you know somebody that's coming from Lagos that can pick it for you. Yes, that's that. Okay, somebody is asking, is there a soft copy to the ebook? Yes, there is a soft copy. Like I said, just send me a DM. I will tell you how you are going to get it. All you need to do is to share your Gmail account and then you receive the ebook. It's PDF. All right. Okay. So that will be the end of today's class. So when next we are meeting, we are going to be starting capital budgeting. So go and read about capital budgeting so that you have an idea. Of course, yes. So that's going to be it for today. Thank you everyone for your patience and then understanding. I will see you next time by the grace of God. Good night.